The common securities, just so that we're speaking the same language and that we're going to talk about here, again, you got common or ordinary shares, you got convertible debt, and then you have new forms that are sort of hybrids or innovations on that. One that has become somewhat common is called the SAFE, and that's a simple agreement for future equity. So it's not equity and it's not debt, it's a simple agreement for future equity. It's a little confusing, I admit, but it's fairly common, and it came into being in the Silicon Valley with people who were trying to make it faster and easier and simpler to raise financing from early stage investors. Another version of that I've seen is a different accelerator came up with the KISS, Keep It Simple Security. Again, that can be either the equity version or the debt version. Another one that's popped up in the last 3 years and is, in some jurisdictions maybe a little controversial with the SEC and others, it's the simple agreement for future tokens. So we're going to be talking about tokenomics and ICOs and STOs, but the simple agreement for future token is another instrument that you're starting to see more of. Another emerging form of financing is one that's basically not even equity or debt. It's a royalty, really. It's a revenue-backed note. And that's where people give you upfront capital, and in exchange, they get their money back through future revenue. It's pretty interesting. Another one that's fairly common is the Series Seed. And the Series Seed is really, again, sort of an open source movement to make it relatively easy for people on both sides of the table to be involved in the financing without running up huge legal fees. So Series Seed is basically a simplified version of a preferred stock traditional VC financing. Again, you've got the preferred stock, and just so you understand the difference. So let's assume that somebody raised $200 in the form of preferred stock, and they got a, quote, 20% interest in the company. And then later, let's assume that company sold for $2,000, right? So the company has essentially doubled in value. With a straight preferred stock, the preferred stock would get the money back, the $200 back, and then the balance, the $1,800, would go to the common. So in this case, it looks like the preferred didn't really get the benefit of the bargain, right? Because they had 20%, but they ended up with 10% of the proceeds. And that's why preferred stock typically includes a convertible feature. So you can get the benefit of whichever's better. You can either convert to common and get 20% of the take, or you can stick with your preferred. So if it turns out that the company sells for $500, for example, the preferred gets not 20%, but in this case, $200 of $500, which is 40%. And the reason behind that is, hey, they invested cash and they should at least get their money back, since the company didn't turn out to create value. It actually destroyed value, $500 in this case. So that's preferred stock. There's convertible preferred stock. There's a couple of other things. There's venture debt. And what venture debt is, a lot of companies, particularly in the innovation space, they don't qualify for traditional bank lending. So traditional banks, it's a regulated industry, and they can only lend to companies that meet certain lending requirements. That's a requirement by law, that the banks not get crazy. We saw what happened with the GFC back in 2008 when the banks started to get a little bit crazy. So it is a regulated industry, and you need to understand that banks' hands are tied. But there are others who are willing to assume more risk in the market, and they are specialized lenders that will help you finance equipment, capital equipment, and that would be usually some kind of a debt instrument with a security interest in the underlying collateral, and then probably some kind of an equity kicker. So that's another way to finance your business and extend your runway. We'll talk about that a bit more. And then lastly, in the last few years, what people have been pretty crazy about is the whole ICO, STO space. A lot of money has been raised and lost. There's a lot of controversy and lawsuits at this point associated with the ICO industry, which is kind of dead now, not totally, and the rise of the new form of financing, which we're going to talk about, which is the STO, or the security token offering. Those are the securities and instruments that we're going to talk about in this course.